Back on September 8th, the Federal Reserve released its latest Beige Book update. Now, if you don't know what the Beige Book is that the Fed releases, it's its summary of economic activity that it collects from the 12 Federal Reserve banks, which roughly represent the regions inside of the United States. And I don't want to go into too much detail on it because, quite frankly, the details are not that important. It is true that the devil's in the details, but it's also true that you could miss the forest for the trees. Instead, I wanted to highlight a couple of important points that was noted in its summary, and it actually comprises 2/3 of its summary. One is its employment and wages, and the two is its prices. So one of the things that they have shown is that they cited that with persistent and extensive labor shortages, a number of districts reported an acceleration in wages. Most characterized the wage growth as strong, including the Midwestern and Western regions. So there is strong wage increases that are going on inside of our industries now. And then the second one is the prices. They say that they noted that inflation was reported to be steady at an elevated pace, which is, quite frankly, contradictory. They're trying to say that inflation is not picking up, but it is picking up. It's steadily picking up. So we're not seeing a hard spike up in inflation, but we're seeing a steadily increase in inflation. And that's continuing to go on, okay? So half of the districts characterized the pace of price increases as strong, while half described it as moderate. So there we go. So they're saying that inflation is going up at a moderately strong pace and that we're having strong wage increases. So why am I citing this to you? Well, nearly all schools of economic thought agree that when wage hikes are going up, absent of productivity increases, that leads to persistent consumer price inflation because workers have more money to spend on the same amount of consumer goods. So there's not really a net increase in consumer goods that's driving these wage increases. Instead, it's these labor shortages in certain areas that are driving it, but it's also having to do with the amount of monetary stimulus that's going on. When you have more money circulated facing rising prices, people are basically demanding higher wages, or they are moving and transitioning over to jobs that will pay higher wages. And the reason why we know this is that it said contributing to these shortages were increased turnover. So people were leaving their jobs. People were going to work and saying, you know what, I don't like this, I'm leaving. Early retirements, that's another one right there, especially in healthcare. Too much demand that's been placed on it. Child care needs, and then challenges in negotiating job offers, that's another one. So if they're saying people are walking away and saying, if you do not hire me at this wage, I'm leaving. And all of that is beginning to force up consistent and persistent prices. So inside of a businesses, obviously, if they face higher costs, they'll pass it off to the consumer in the form of consumer prices. So I've gone over 4 areas that I know of off the top of my head that generally are the input prices for businesses. And once you measure those 4 areas, if all 4 are going up, that is a definite sign of inflation. Right now, 3 of them going up. So the 4 of them are land and real estate to build and do business on, to construct and produce. That's going up. That's going up very high. The second is the cost of materials. That's going up. The third is the cost of labor. That's going up. The fourth is interest cost on debt. That's the only thing that has remained stable or arguably has gone down. So 3 of the 4 input cost areas for businesses are going up. That's definitely a sign that there's inflation. And when we combine it with the reports that we're seeing that numerous companies are planning or have hiked prices, that's also going to continue to inflation. So out of a 5
All right, so there was a huge press conference yesterday, ostensibly.
that came out at the end of June. It was June 26th. Here's a number of companies that are saying that they're planning on lifting prices or have already done so. So Clorox is, especially with its Glad products, so it's plastics and trash bags. There's General Mills, that's food. There's Constellation Brands, that's beer, but they're just saying they're going to lift it up to 1 to 2% annually. Coca-Cola, which covers a whole host of things, they're planning on hiking it up and in the back half of 2021 and 2022. That's a key thing. Some of these have not come into play yet, and we're going to be seeing these now in the last waning months of 2021. Kraft, Heinz, Kellogg, Tyson. Tyson's another one that said that they're facing margin pressures during the back half of the year, meaning the second half of 2021. So they're going to be hiking prices. They've already signaled that they will. And then let's take a look at the home price index. So the home price index report from Case-Shiller is continuing to push up. Look at June's. June's has gone up to 18.6% year over year price inflation, okay? So the index now is higher than it has ever been before, and there just shows no sign of calming down from this, and that's faced from those inventory shortages combined with monetary stimulus as well as reduced supply off the markets of natural housing because of eviction moratoriums and people not being foreclosed upon because they have been able to utilize certain emergency programs provided by the federal government that allows them to delay or forbear their mortgages. Then there's the Redfin indicators here. They're also showing huge increases in housing prices. And one thing to note here is that they showed a slight decrease in housing prices in July 2021. So that kind of gives us a little bit of hope that maybe we're going to see a peaking in housing prices. Though how much that remains to be seen, we don't know. And of course, you know, how aggregately accurate this is compared to Case-Shiller in terms of methodologies. This is more of a general roundabout thing. I honestly don't know. My opinion, I don't think that we're going to see a moderation in the housing prices yet. But even if we did and say that we peaked in June of 2021, we're still looking, this is what would have on the CPI. We are still looking at a minimum of 2% CPI inflation from this going into the end of 2022 and a permanent increase year over year of 1.1% inflation in the CPI. So that's all of this is definitely telling you that these inflationary pressures are being felt, and it's a combination of fiscal policy, monetary policy, and yes, the COVID variants and the shutdowns and the disruptions in the supply chains from that. So that's definitely pushing that up and is causing pressure. The real concern that I have, and I'm just going to give this to you, is if we start seeing those interest cost increases, aka we start seeing interest rates go up. To me, that's the real thing that we need to be worried about, and the threat that higher inflation has is that it should sooner or later force up those interest rates. But as I've said in my previous video, there's no way of really telling when that's going to happen. There's no really way of telling when investors are going to get fed up and dump the debt instruments and debt securities. As long as they continue to keep buying more than the supply, or at least in tandem with the supply, those interest rates are not going to go up. And the Federal Reserve is, of course, subsidizing and augmenting that by buying $120 billion of a combination of Treasury securities and mortgage-backed securities every single month. And so anyway, this inflation trend is going to continue, and it's definitely something that should be on the forefront of everybody's minds, and to prepare for your investment strategy, but also for your consumption habits today. It may be time to start cutting back on some of that extra consumption that we're doing and engage in some savings, even if it's investing, just to try to maintain and preserve wealth and get into a wealth preservation mode, so that way it doesn't get eroded. Guys, thank you for watching this video. If you like my content, make sure you click that like button, show me some support, comment below, let me know what you think, subscribe to my channel if you haven't already, click that notification bell if you haven't already. I'll probably produce the next video on Tuesday evening when the consumer price inflation reports come out. It's definitely going to be eye-popping one way or the other. As I said before, I'm expecting at least a 1% increase on the CPI monthly index. It's just from those final demand numbers. So we'll see how they come out, and I'll give you the updates then. Thank you for watching this video, and I'll talk to you next time.